Hello, everybody, and welcome to the Cyclical Investors Club YouTube channel. My name is Corey Kramer. Today, we're going to be talking about dividend stocks. I had a request for the ETF SCHD, and I just want to talk about dividend investing and dividend growth investing in general. As always, this is not individual investing advice. This is just my take on stock investing. Okay, so I'm going to cover, I have a list of like 3 of the bigger kind of myths or issues that can come up with dividend investing. And then I'll give some broader context, share my thoughts on dividend growth investing, and SCHD, which there's been, I don't actually watch them, so I probably shouldn't comment, but judging on the titles of some of these ridiculous YouTube videos where people are like, the only thing you need to get rich is SCHD, and I don't watch them because I know it's BS basically. But so I've been doing this for 10 years now, been creating investing content, writing about investing, and then I relaunched the YouTube channel in 2023. And when I first started back in 2015, dividend growth investing was really kind of taking off, especially over on Seeking Alpha. It became kind of a dividend investor haven. And a lot of that dividend growth investing made a lot of sense back then. So I want to definitely give the context behind why I think it's become popular and some of the fallacies I guess you need to watch out for. Or commonly held beliefs that aren't really true or are misunderstood. So the first thing I want to do is make a positive case for dividend and dividend growth investing. For retirees back around, well, post Great Financial Crisis, we had a big decline in the stock market, so people were a little bit leery of stocks in general. But as the decade went on, the classic portfolio allocation of 60-40, where you have 60% stocks and 40% bonds, was in trouble a little bit because we had probably nearly 40-year, by the time we got into the 2020s, it had been about 40 years of a bond bull market. So we were having periods where bonds and stocks weren't, or they were more correlated. Interest rates, which is the inverse of the bond yield, were huge in the very early 80s, almost unbelievably huge to today's eyes. And every now and then they would go up and down, with recessions and the Fed making adjustments too. But for the most part, they went all the way down to effectively zero after the Great Financial Crisis. So from that point on, you weren't getting any yield from your bonds, like long-term, especially like long-term bonds, government bonds. And investors realized that. And so it was smart for them to try to find a substitute. Now, the idea of the 60-40 is when the market goes down, the stock market goes down, often the bond market will go up because people flee to safety. And then you can rotate that will, one, reduce the drawdowns in your portfolio. So if you're withdrawing for retirement, that lowers the sequence of return risk. And we had just come off the worst period since the Great Depression from 2000 to 2009, where that was a real thing. Like sequence of return risk was a real thing. There were people's retirements that were destroyed from that period. So all that made sense, but people could tell that the bond end probably wasn't going to hold up because interest rates were zero, like they couldn't really go any much lower. And when they went looking for alternatives that also had some sequence of return risk protection, the dividend growth investing looked pretty good, especially when maybe we can put the dividend yield for the S&P 500 up here. So this is just going to be the S&P 500, so you're not even looking for dividends. I think what we want is this. They added that little red, there we go. So you look here, and just for the S&P 500 around 2011, we're getting a 2% yield here, 1.8% yield, not quite as good. If you bought when it was really cheap, you could have got a 3% yield. So 2% isn't a very good dividend yield, but it's better than zero, right? And you have a business that can also pass inflation on potentially if you're buying something like the S&P 500, they usually can. So that started to look more appealing, and then all you have to do is commit to not selling during a downturn and collecting your dividends from there. So the S&P 500 dividend yield was maybe like 2% during this time period, but you could go and find stocks like of decent companies that were 3% to maybe 4% yields back in here, okay, when the dividend boom started taking off. That all made pretty good sense if you didn't. I mean, investors made a lot of mistakes. They bought a lot of energy companies during a boom or as the boom was falling when the yields got high before all the dividends got cut. They definitely made some mistakes there with pipelines as well during that. This is kind of like the 2015, 16, 17 period. So individual investors that were buying stocks made some errors there, and I've seen a lot of them written about, so I know. I was writing during this time, so I was involved. And so what happened, though, is as more people... So that was a good strategy back during kind of 2010, 2011, 2012, 2013. I think maybe even 2014. And then the valuations start to get trickier when we get into like 2016, 2017, 20, right? But the problem was the 60-40 was still garbage. And so it still was the best alternative available for someone who wanted a simple strategy that they really just had to commit to. And the people who got into dividend investing way back here are still doing okay. So that hasn't like totally crashed out for them yet. When I started really sounding the alarm bells was from maybe like 2018 and then especially up to I consider this the peak right here in 2022, which I'll look at here in a minute. All this stuff is just AI. Like everything above here is AI. The real peak took place at the beginning of 2022, which we'll find out here once the S&P 500 looks like it's crashing. So that's a different topic. So my real critiques came for the dividend investors and warnings. I mean, it was really just me warning people about the valuations because they didn't make any sense. And if you look at the dividend yield, we'll just look at, unfortunately, I don't have access to the dividend yields of other ETFs other than S&P 500 right now on Fast Graphs. But look at the peak here, and it's representative of dividends. They might be higher, but you're going down in quality scale, okay? And we'll get into SCHD and NOBL here in just a second. But you can see the peak low of the S&P 500 dividend yield, 1.2% going into 2022, was the peak, I think, of the dividend bubble. And we're just about there on the S&P 500 now. Well, almost just as bad, see? But not quite. But most of that is just because of the Mag 7 or whatever. It's not necessarily the dividend stocks that are doing it. Okay, so the problem is when the valuations of these stocks go up, your yield goes down as a dividend investor. So old dividend investors back here are doing okay because the value of their stocks have gone up. It's the... I don't want to say bag holders. It's the late investors that came in here that were getting like a horrible deal. But the problem was at the peak here, the 60-40 was a horrible deal too, right? However, what I will say is after that, starting around 2023, when the Fed started raising interest rates and interest rates went up, all of a sudden cash because remember, cash yielded 0. So you were losing to inflation with cash until about 2022, 2023, right? 2023, definitely. And so the whole landscape basically changed once you could earn 5% on cash for short-term treasuries. So now the trade-off was 1.5%, or maybe if you buy a dividend fund, you might be able to get up to 3%, but you're taking risk when you could get 5% risk-free. And so that's when I think the whole dividend thing should have just, people should have realized, and they did slowly, but not fully yet, I don't think. And so when the valuations get high, the problem is, one, the yields get low, so you're not getting very much yield. You're not getting a 2% yield that you could, or a 4% yield you could live off in retirement, right? So if you think of retirement, 4% yield plus inflation growth, you need, if you could buy a dividend ETF that had 4% yield and plus inflation growth, then that would be fine, right? Or a 60-40, but you couldn't get those things back at the peak. I don't even know if you can still get them now. You probably can't. Not yet. All right, so that's the problem, is people just forgot about valuations. It's literally the same thing that happens with growth stocks, only it happened with dividend stocks. I mean, totally nutty. Some Walmart, Costco are still crazy. Like, there's some of them that are just still ludicrous, right? And people think they'll be defensive because some of them were defensive, like McDonald's back in 2008, but that's because it traded at like a cheap valuation. Let's look at that one, because I got a troll who keeps coming on my channel and talking about McDonald's. So you go back here. Okay, so you can see that it basically, the stock price didn't decline at all. I mean, barely back here, but it traded at a 14 PE ratio. Okay. So, and it had fallen, if you go back to this peak from the 2001 or 2000 highs, it fell like 80% already. So it hadn't really recovered since then. And so the valuation was low. It was 14. Well, what do you think the valuation is now? Double that. So that means, in order to assume, and their earnings are falling, right? Back here, their earnings were growing 20% per year. 20% per year earnings growth. Even during the recession, it still grew 8%, and it's trading at 14 PE, okay? Go up here, you have a 2% EPS decline. You have double the PE, all right? I mean, it's totally crazy. And if just the PE reverted, that's a 50% stock loss, reverted back to the Great Recession levels. Nothing changes. If the earnings just, nothing changed, it could just immediately just go down 50%. So to get back to these valuations, that's what people don't understand. They don't understand, look, the valuation was relatively low. The earnings growth was relatively high. Over here, that's not it, right? It's just not the same situation. So you shouldn't expect the same thing to happen. And there's dozens and dozens of stocks like this. So SCHD, let's talk about it. Actually, let me go over a couple of myths with dividend investing. So one of them, I just read another article. I see these all the time. This was over on CNBC. Maybe you can go find it. It was just this week, where it's like 80% of stock market returns since 1960 have come from dividends, right? Well, there's a couple reasons for that. One is they have to go back really far in time in order to make that work, because the past 20 years, most of the stock market gains have come from tech companies that weren't paying dividends most of that time. So it's not true the past 20 years. It's just not. But the bigger issue is that most stocks are garbage, okay? Most of these businesses fail to produce good returns for investors. So when you lump the whole stock market in together, the dividend ones that are paying dividends are probably earning money, right? Sometimes they borrow and pay dividends and try to trick people, but for the most part, that's the case. So you weed out a lot of the garbage just by only looking at the dividend payers, or the dividends that were paid. But the thing is, if you just used one more filter and you only took the companies that had earnings and earnings growth for through one business cycle, like one recession, they earn money, 2, they grow their earnings, and 3, they get through one recession. If you just apply that filter right there, most of the returns would not come from dividends. Now, I don't have the resources to go and do that research. It would be good if a university actually did. Arizona State actually does a lot of research on stuff like this, and you could go read their research. Don't think they've done. It's hard because it's hard to get those earnings data from like every business and set the parameter. I mean, you need a team of like graduate students and stuff to like go do that for you, but it's possible to do it. And I'm very certain that you would not find the 80% of the returns, especially if you started it in, 1980 or something, would come from dividends, right? So don't fall for that myth, basically, is what it is. I mean, they're not lying. It's just poorly constructed research. It's because it's easy. Looking at the dividends and then just looking at all the other stocks is easy. It's a lot more work if you want to filter out good businesses from just all the other garbage that they have. So the stock market's produced over the years. All right. So the other thing is you need to be careful about, like right now I see a little bit of it's fallen apart today in the market, but a little bit of rotation to kind of consumer staples, utilities, stuff like that in the healthcare, things of that nature that are considered defensive. You have to understand that a lot of money managers are not allowed to hold cash. So when they want to get defensive, they shift their money into those type of investments just based on, I don't know, there's probably even like a Wall Street playbook or whatever that is there. But they don't have a choice if they want to get defensive for a recession. So they can influence and they can reduce volatility that way until things get really bad, and then everything gets sold off. But the problem is a lot of those businesses are really low quality businesses, and right now they're actually not cheap. They're low quality, and a lot of them aren't cheap anyway. So it's a rotational strategy. It's really a trading strategy designed to reduce volatility for people that are in their funds so they don't freak out and sell them, and then they don't get the commissions from the fees and stuff from those people if they go to pull their money out and put it in cash. So it's a way for them to try to reduce volatility, but it's not a way, they're not like buying quality businesses or not the best ones that will produce good returns over 5 or 10 years or something like that. They're trying to reduce volatility, and then they'll hopefully try to time the market and get back in. So there's not anything safer about a lot of the staples, especially given the valuations that they're at. And the goal there, again, is just these equity money managers don't have a choice to hold cash. If you're an individual investor, one of the best advantages that you have in markets like this is you can hold cash. And cash isn't going down, or short-term treasuries. I like TFLO is what I like for that. So you can, because I hold growth, like the highest quality, faster growing businesses on one part of the portfolio, and hold cash on the other part of the portfolio. This past couple of weeks, the market's been falling, and the Cyclical Investors Club portfolio's falling at half the rate. I mean, it's long only, so I'm not shorting anything. So it's going down, but at half the rate or less. There's some days like a third of the rate of the S&P 500. So, which it doesn't take too long for the S&P 500 to fall past us. Now, you have to accept that on the upside, if you get defensive before the market peaks, you're going to underperform. You're not going to perform as well, which I haven't performed as well as the S&P 500 the past 2 years. We were outperforming going into 2023, but when AI took off, I was still getting pretty defensive, only buying individual stocks that I liked. And I've just kept doing that, and the returns have been good, but they haven't been these kind of crazy high returns. So that's the price you have to pay on the other end. You have to just know what type of returns on the upside you're willing to be happy with, And then you have to be patient on the downside and let these opportunities come to you. But you can do that as an individual investor, whereas now hedge funds have more flexibility, but a lot of these money managers, they have to be 100% invested in stocks. So you don't have to rotate into some garbage utility that's trading at like 20 times earnings that only grows at 2% a year. You can just hold cash. So I wrote this article on SCHD on Seeking Alpha back in 2023, which was, I really love the title. People gave me a lot of good, lose money slowly with SCHD. It was a little mean. My articles actually, I basically explain everything that I'm talking about here. So, and since then, it's positive so far, but underperformed the S&P 500, right? And I would say that SCHD is the best dividend ETF. So this is the best one. Most of the rest are worse. Pretty much all of them I've seen are worse. There might be some very similarly constructed. So SCHD holds like 100 dividend stocks. They have some screeners for cash flow, I think, that needs to be met. And then they try to find like the higher yielding ones. I want to say they rebalance once a year, and it is possible for them to get lucky on that rebalance and happen to buy things that are sold off temporarily. And so that gives them a little bit of an X factor where they might be able to outperform sometimes, but it's really just based on luck. And it could go the other way. They could rotate into something, that's bad, right? So if you look at let's see if I have top 10 holdings, which is almost half their portfolio weighting, right? We have healthcare, drugs, healthcare, drugs, healthcare, drugs, healthcare, drugs. So let's call it 20% of their portfolio is in drug stocks that are very hard to predict, okay? You have a deep cyclical in Chevron, deep cyclical in Texas Instruments. So you have some cyclicality, and then you have no growth, no growth, no growth, no growth, or very little, like inflation growth. You get inflation protection, but nothing really effectively beyond that, right? So in my article that I wrote a couple years ago, I pointed out that the revenue growth of the top 10 holdings at that time was like horrible. It was really bad. And they just aren't great companies. They're okay. Like they're just trying to kind of hold their own, and then they're paying all their money out to investors. Again, it's okay, but I think it was yielding like 3.3% at the time. It still wouldn't be enough to withdraw 4% just from the dividends. So you would need to have more. And what that means is people are just paying too much for the stocks. Because when you pay more for the stock, the dividend yield goes down, right? It's inversely correlated. All right, let's get my background back up here. What else do I have here? Yeah. All right. Let's look at, so back in the day, so SCHD didn't used to be a thing. Like it was around, but nobody paid any attention to it until it started doing well. And until all the other dividend strategies that people were buying sucked. And then everybody noticed SCHD and it was like, oh, if you filter for quality and then you aim for, and then, and that helped because a lot of times people were chasing high yield. They're buying like 7, 8, 9, 10% yielders. Horrible businesses that are like on their last legs, but they're still paying out a dividend as long as they can before they have to cut it. And sometimes go bankrupt. And so people were getting really into that because when the prices got high, the dividend yields got so low, they weren't big enough for retirees to just live off the dividends, which is the whole idea behind it, right? So I went to the market peak for this chart here. The real market, like I said earlier, 2022. And I'm plotting T-flow, which is short-term treasuries, my cash kind of position, with SCHD, NOBL. I think NOBL is more representative, honestly, of most dividend growth investors. It's a dividend aristocrat. Like that was a big thing, a dividend streak. Like if you have like 25-year dividend streak, then you know that means the company's great and it's going to keep going. be able to pay their dividends and so forth. And so that was the screen used for that ETF when it was created. And then I also included the 60/40, which in my view is the real competitor to dividend growth, to dividend and dividend growth investing. So because the dividend growth is kind of making up for the fact that bond yields sucked. So all these strategies, by the time we got to 2022, were not any good, or not as good, not very good. And since then, I plotted this with just holding T-flow and the dividends. These are all total returns, so they include dividends and payouts and everything. And you can see that right now, SCHD is a couple ticks ahead of T-flow. But here's the thing. The market's, I'm looking over at my Bloomberg TV over here, is down again today. And so these will probably fall even farther. And T-flow is not going down. Like you can look at its line compared to all these other investments. It basically only goes up. Now inflation can eat away at it. If I plotted inflation here, it would be almost the same as T-flow. So really you haven't made any money with T-flow, but you haven't lost any money, and you're not going to lose any money the way you might lose money with the equity dividend strategies. Okay? So it's already outperforming. Well, you can see during most of this period until we had this kind of blow off with the market, T-flow outperformed all these stocks easily. The 60/40, again, similar, only returned 10%. That's less than inflation. So all these stocks, once SCHD falls a little bit more, it'll be under inflation rate. Inflation, I think, is around 13. It's almost the same as T-flow. And what you're going to have here is 1, 2, 3. We are into our fourth year of what is probably a lost decade for these strategies. And it's probably the next couple years are going to be negative for sure. I mean, I think 5 years is a sure thing of lost value from the peak in 2022. Inflation adjusted, I mean. And then it's a question of, does it, how far does it go after the 5 years into the 10? It could easily go 10, I think. So, especially the rate things are going right now. So, there's still time to get out of overpriced dividends. Utilities are ridiculously priced. Let me just pull. I don't know what we'll do. I can remember Con Edison. I can't remember all of them. But let's just look at this one. 20 PE, 4% growth. Just bonkers. It's totally crazy. It doesn't make any sense at all. Go back here to the reality, anywhere, pick here. Got a 15 PE. That was when, I guess I only had 2 or 3% growth. But basically the growth rate on a utility is going to be whatever inflation is. So the dividend yield in this case is actually what you get as an investor. So this is probably better to look at. Let's go pre-GFC, before interest rate went to zero. You get about a 5% dividend yield if you would have bought there, 2005. Okay. During all this time, once, and it was trading at a 15 PE, that's traditionally what you would get with a utility. Now we get only a 3.72% dividend yield and a 20 PE that could, if it reverted to a 15, you lose 25%, which is how many years of dividends, at a sub 4, you're looking at like, you lose 6-7 years of dividends if it just reverts to normal. And so it's not just this one utility, like they're all like that. So, and people think they're safe, right? And actually you can see with the market here, oh man, it's scary what could happen to folks. So this is up 20% since the beginning in the past 2 months. This is what I'm telling you. This is portfolio managers go into safety, right? It's a good opportunity to get out if you're if you own a bunch of utilities. And the thing is, you don't have to go buy stocks with them just yet. Go buy treasuries. Earn, I think T-Flow is still at 4%, maybe a little under 4% yield. You get the same yield in cash, and you have no downside risk. But people probably won't do that because they'll think they're smart, you know, because it just went up. I mean, it's just back to where it was over here. But if you're an individual investor, use the mistakes that the money managers have to do to your advantage, all right? That's what I'll say. And be patient. There's no rush. The market has a, I'm not predicting how far it's going to go, but it's not even at fair value yet. So it's not about being scared. I bought one stock today. I bought one last week, like small positions. I'll keep pecking away if they keep giving me the prices I want. But I mean, it's not like the market's only down 10%. During a recession, it could fall 60. So imagine how you feel after a 10% decline, and now multiply it times 6. It's probably more like an exponential fear too. I made a video 2 weeks ago where I talked about cash. You know, I talked about all this before ahead of time because I don't want to just make individual videos without people having some context that you can't buy stocks on the way down if you don't have any cash or after they've gotten cheap, right? Okay, enough lecturing from me. Hopefully you guys found that interesting. And my take is I mostly want to own high quality businesses. I define that by the ability to grow earnings through a business cycle. It doesn't have to be every year. You know, if there's a recession, earnings go down, that's fine, but they should be able to recover okay. Doesn't have a lot of debt. And I want to buy those at fair prices, like preferably good prices. And then I will also buy cyclicals when they're near cyclical lows, or far off the highs is probably a better way to say it. And that's kind of the playbook. And if everything's expensive, I want to have cash so when they get cheap, I can buy them. I want all my money to be 100% stocks, like all my investing money. And right now I'm like 40-something% cash. So, all right, hit the like and subscribe if you liked it, and I'll see everybody later.